if you look at the last 10 years, this is an astonishing fact. Gold has been the least volatile asset of any. The stock market, the bond market, certainly crypto, foreign stock markets, currencies, the dollar even. They've all been more volatile than gold. And so what you want as a reserve asset and what you want as a liquid asset for banks is a non-volatile asset. So, no, gold to me is the ideal asset for that function. I'm not one of these wild-eyed people, but I think 45 to 5 is not unrealistic.
Yeah.
AdrianDay, chairman and CEO of AdrianDay Asset Management, believes a gold price between $4,500 and $5,000 is a realistic target, not an overly aggressive prediction, but a logical outcome in the current macroeconomic environment. While geopolitical events, such as the Israel-Gaza conflict, tensions with Iran, or escalating tariffs may give gold a short-term boost, Day views them as accelerators rather than core drivers of the metal's long-term strength. The real foundation of gold's rally lies elsewhere. Central banks have become a powerful force behind the current bull market, buying gold at a pace of roughly 80 metric tons per month, worth approximately $8.5 billion at today's prices, according to Goldman Sachs estimates. While much of this buying remains opaque, trade flows suggest significant accumulation by China and other unidentified entities, funneling purchases through Switzerland. This steady, large-scale buying is a strategic move to diversify reserves and reduce exposure to the US dollar, particularly in light of the dollar's increasing use as a geopolitical tool. Chinese investors have also played a key role, ramping up gold purchases over the past year amid concerns about yuan devaluation and ongoing instability in the banking sector. With limited confidence in their financial system, many are turning to gold as a store of value outside of the traditional banking framework. From a technical standpoint, gold remains supported, but its short-term direction depends on upcoming U.S. non-farm payrolls data and statements from Federal Reserve officials. As long as the dollar doesn't stage a strong rally and Fed rhetoric remains relatively neutral, gold appears poised for another test of resistance around $3,435. A clear breakout could open the path toward the $3,500 level. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Fundamentally, as we know, for the last 3 years, fundamentally, the gold price has been driven by central banks, diversifying their assets in the face of dollar weaponization. That's been the fundamental driver. And then you've had Chinese investors in the last maybe 12 months, 10 months, who've really ramped up their buying in the face of concern about a yuan devaluation and a weakening Chinese economy, and concern about the banking system. So they're not putting money in the bank. They're protecting their assets by buying gold. Neither of these two factors, which have been the main factors driving gold for the last 3 years, are really related to trade, Trump, US, and they're not really related to the macroeconomic environment. They're related to very specific things. I think more recently we've seen more buying come in relating to the fiscal issues. It's not just the US. The US is the US is the most serious because it's the reserve currency. But many other countries in the world have fiscal problems as bad as or worse than the US. So, people are beginning to react to that, and how do we get out of this situation? So, I think things like, and I don't mean to downplay it, but things like Israel and Gaza and the threat of Iran, nuclear war, boy,
Yeah.
These are and tariffs. I think these are sort of, as it were, an icing on a cake. I don't mean to put, that's the wrong expression.
Yeah, it's just helping push it a little bit higher with this.
They're gold positive, but they're not what's fundamentally driving gold. Look, let's face it, if you look at the last 10 years, this is an astonishing fact. Yeah. Gold has been the least volatile asset of any. The stock market, the bond market, certainly crypto, foreign stock markets, currencies, the dollar even. They've all been more volatile than gold. And so what you want as a reserve asset and what you want as a liquid asset for banks is a non-volatile asset. So, no, gold to me is the ideal asset for that function. I think so, absolutely. It's going to start competing with sovereign bonds, and particularly with the US dollar, of course, because for various reasons, many foreign governments don't want or are less keen, let's say, on US bonds than they were. But frankly, it's not just US bonds. US bonds have their own particular difficulties. But really, long-term bonds of most countries around the world are simply not attractive right now. I mean, they're just not attractive. So the only people who would be buying, let's just say US right now, I mean, the only people who would want to buy a 30-year US bond at, less than 5% are people with long-term liabilities like pension funds and insurance companies.
Yeah.
But an investor, would you buy a US bond for 30 years and hold it? Of course not. And expect to make money?
Yeah.
Of course not. And that's true for many countries around the world. So I think gold is the ideal asset. I'm not overly concerned about, it's to be expected, and I think we've mentioned this before, that the buying from central banks would slow the pace of growth. It's been the rise from really 2020, 2022 particularly, and then, has been so dramatic. But if you look at the buying for the first quarter, we only have the first quarter numbers, and then we have April's numbers. It's still well above where it was in the teens and the O's. I think the big issue is that we talked earlier about, the central banks and the Chinese consumers who are buying for particular reasons. But what they're not buying for is because of the macroeconomic environment, right? So typically, when the economy is seemingly strong, inflation is low, interest rates are high, the dollar is strong, that's not a conducive environment for buying gold. And so for ordinary retail people, I don't mean as a defensive asset, but, an ordinary investor, that's not the environment which is attractive to gold. And that's really been the environment that we've had for the last several years. Yes, we had the weak GDP numbers, but there were all sorts of excuses about that, and it was just brushed off. Now, when you come to the stocks, you add another factor to that. When the S&P and the TSX are going up month after month after month, you don't look for other things to invest in. So what I suspect, and we're beginning to see cracks in the economy right now, right? It's pretty clear in the US that the economy's slowing, retail sales only being held up by high credit card debt, so that's unsustainable. Jobless in the US, new jobs creation numbers are high, but literally a majority of the new jobs created are either government or part-time, so that's not healthy. So we're beginning to see these cracks in the economy, interest rates, they're going to have to cut them at some point, and the dollar is, let's say, volatile.
Yeah, to say the least.
So we're beginning to see the macroeconomic environment for gold turn more positive. And I suspect what we're going to see when the stock market, when the erstwhile leaders start to falter, they don't have to collapse, just falter, people are going to start looking elsewhere. We saw this in January, February, when, Nvidia and Microsoft and Tesla had their big drops. Yeah, and money started flowing into European equities. So I think we're going to start seeing people look for other places to put their money. It might be European equities or global markets. It might be emerging markets. It might be small cap. It might be value, which is grossly underperformed. Right. Defensive stocks, income stocks. But part of that, one of the areas which has underperformed where people will look are commodity stocks, and particularly gold stocks. So I think that's what we're going to see when the macroeconomic environment shifts and the stock market shifts. And one last thing about the stock market, if I may. One thing that I don't think has been focused on enough is the amount of money from overseas that has been pouring into the US stock market month after month after month in the equivalent of the 401ks, just automatic passive investing into the US stock market. Now, when President Trump, and I had to say the word, I'm sorry, when President Trump, when the administration in effect makes it clear to foreigners, we really don't want your money, the dollar's going to get weaker, we don't really care about the stock market, and we don't really like you anyway, that money at some point is going to stop flowing into the US.
Yeah, what does that mean for the 401s?
It's very, very significant because it's about 20% of the flows into the US are coming from abroad.
Wow, and a lot of retirement savings in that as well, I would assume.
Yeah. Just automatic rollover.
ETF buy.
And that's going to change. I think that's one of the most compelling factors coming up. If the US has here's what I think is going to happen. Although here's what I think could happen. The US, we all know, is having difficulty funding its deficit, and it's doing it increasingly at the short end. I don't criticize Besson for that because he was handed basically an empty treasury. And in fact, Janet Yellen on a Friday night interview on January the 19th or whatever, before Trump was sworn in on the Monday, said, I can't remember the quote exactly, but it was basically, there's no more money. Oh, that's right. She said the treasury is likely to default by Tuesday. And so I don't criticize Besant for this. He has to fund at the short end. Because to fund at the long end would mean significantly higher rates at this point. People would demand higher rates. But we've got the debt ceiling issue, which is a whole different subject, but we've got the debt issue. And everybody, including Besant, including the Treasury, say that by the end of summer, the U.S. is going to run out of money. And so, I think if that comes to a head, the U.S. isn't going to default, but something's going to happen. So I think what's going to happen is that the Fed is going to institute QE again. Now, that's not an original idea for me.
September?
Although I claim it I think by the end of summer, September, they're going to be QE again. They may not call it QE, but we'll have QE. And I think QE is much more likely than dramatic interest rate cuts, frankly, because the concern right now is not the job market, which would mean you want to do rate cuts. The concern right now is the funding of the federal government, which means QE. Rate cuts don't do much for funding the U.S. government. Well, I think there's obviously going to be, I wouldn't be surprised if it doesn't pass. It's not going to pass the Senate, in my view, in the current state. Now, there's going to be backwards and forwards. It's a tough situation because the more you give on this, then there's other people in the House who say, well, we don't like that. But you're right. It's extending the tax cuts, which I think is a good idea. Just always and everywhere, I'm in favor of lower taxes, but particularly with the economy the way it is, lower taxes is a good idea. There's some cuts that are good, but overall it's just boosting spending.
Yeah.
AdrianDay highlights that senior gold mining stocks continue to offer substantial value, even after posting impressive gains of 44% to 45% over the past year. While prices have climbed, the key distinction between price and value remains important. Valuations in the sector are still considered attractive, particularly when measured against fundamentals like cash flow and asset quality. This past week saw notable double-digit gains in several mining stocks, primarily driven by renewed geopolitical tensions and a 2.7% increase in gold prices. IAMGOLD surged 8.9%. Goldfields climbed 9.5%, and Fortuna Mining jumped 12.1% as investor interest returned to the space amid escalating tariffs and growing east-west friction. Australian-listed shares of Newmont Corporation, the world's largest gold miner, have also gained close to 30% over the last 12 months, reflecting a broader trend of strength in the mining sector. Meanwhile, Citi analysts remain bullish on Northern Star Resources, expecting it to outperform its peers from the fourth quarter onward. Once fiscal year 26 earnings downgrades are fully priced in and the company completes the sale of its 3.4% stake in Gold Road Resources, further upside is anticipated. Citi maintains a buy rating on Northern Star with a price target of $22.30, indicating an 8% potential gain from current levels. Let's get back to the interview.
Two things. First of all, I think the valuations on the seniors, by and large, are still good.
Yeah.
They're still good value. And, as Oscar Wilde said, there's people who don't know the difference between price and value. Yeah, the prices are good. They've gone up, 45% in the last 12 months? Yeah, something like that.
Good little run.
44% in the last 12 months. Nothing to sneeze at, as we say. I don't know if you say that in Canada, but anyway.
They do.
Okay. But the valuations are still low. You look at... Barrick obviously has its own problems, but Barrick's trading in its lowest decile of price to NAV in its entire history. And it's had political risk for quite a long time. It's had other risks for quite a long time. Agnico, obviously the creme de la creme, is trading in the lowest 20 percentile, if that's a word, the lowest percent, lowest 20% of its 40-year history in terms of price to cash flow.
With the highest margins ever.
So these valuations are very cheap. As you say, the lower down the food chain you go, then the better the valuations become. What's going to change it, I think? I think first of all it's the macro environment. The macroeconomic environment will change to where people want to buy gold for what I'll call traditional reasons, right? Which is, lower interest rates, higher inflation, weaker dollar, softer economy. That's the macroeconomic environment that makes people turn to gold. Yeah. And when the stock market, as I say, whatever word you want to use, rolls over, runs out of steam. When you open your statement, whether it's email or I had a picture of people opening envelopes. They don't do that anymore. When do they? But when you open your statement every month and it's not going up every month, then you start to think about somewhere else to put it. So I think that is what's going to change it. Now, the wide margins and the increasing margins, which translates to increasing free cash flow quarter after quarter, that's beginning to get interest from value investors. Because there's no other sector in the US, certainly in the US, there's no other industry sector with such high growth in cash flow. I don't think royalty companies are overvalued at all. The valuations are rich. Ben Graham, Graham and Dodd fame, Ben Graham would probably walk away, or he'd probably run away from the royalty companies. But they sport high valuations for a reason, for a very good reason. And that is the business model is a very, very low-risk business model. So as a foundation of if I were new to the sector today, just brand new, I just inherited some money, whatever, I would definitely buy the best of the royalty companies as a foundation of my portfolio. Things like Franco and Wheaton. Gosh, even at today's price.
Yeah, it's
maybe.
Wild. Randy, he'll be coming on soon. Yeah.
Oh, well, tell him I said I would buy it. Yeah. Even at today's price.
Even at today's price.
But the thing about the royalty companies that people really misunderstand. They think that the royalty companies are great for a bear market. They hold up better. But in a bull market, they don't give you the leverage. For royalty companies, and by royalty I mean royalty and streamers, but royalty companies have plenty of leverage. Not only, of course, does their revenue go up with the stock price, with the gold price, without any extra capital, but typically when you create a royalty or stream, I'm not talking about the legacy royalties that people buy, like Franco's on Gold Strike, but when you create a royalty, the royalty companies are very, very careful to get as much of the surrounding ground as they possibly can, so that when the mine runs out and there's brownfields exploration, they're still exposed to that. And think about it, they're buying a royalty or a stream. They're buying a stream today on a particular asset. The mine is in life for, 5, 7, 10 years. Then it starts brownfields exploration, and then it starts developing those ounces and bringing them into production. And the royalty or streaming company gets rewarded for that without spending an extra penny. Now, I don't know what you call that, but I call that leverage. Yeah. So I think they're a great foundation of a company, of a portfolio. There are people far better, far more knowledgeable than I about the individual stocks. So I tend to stick with physical uranium, like the Uranium Trust, the Sprott Uranium Trust, and the major producers like Cameco, even Kazatomprom, which we know will do well. And then we're buying a few of the near-term, the developers, near-term producers in the US and in Canada. I'm not really getting into a lot of the exploration companies. I don't know them well enough, but I'm also a bit concerned that even with all of the new regulatory deregulation push in the US,
that executive order,
there's going to, which is very powerful, very powerful. I mean, just think, they actually put a mining guy in charge. Can you believe it? Wow. Whatever next? There's always going to be local opposition to a uranium mine in your backyard, always. And so things are going to be a bit slower. But I think the story is very powerful and it's got multi-years ahead of it.
The persistent climb in gold prices is not merely a reaction to global flashpoints, but the outcome of deep-rooted monetary and strategic shifts. Institutional demand, particularly from central banks and cautious investors in economically strained regions, is shaping a structural revaluation of the metal. At the same time, mining equities are emerging as undervalued assets, offering solid fundamentals and momentum despite their recent rallies. This dual narrative, substantial physical accumulation and resilient mining sector performance, underscores the evolving role of gold as both a hedge and a growth asset in an increasingly uncertain financial landscape. Could this strategic repositioning toward gold and mining stocks reflect a broader rebalancing of global capital away from traditional fiat instruments? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.